The silver market just experienced something absolutely unprecedented. On January 30th, 2026, silver prices collapsed by more than 35% in a single trading session. Let me say that again, 35% in one day. This wasn't just a bad day for silver investors. Now, this was the largest single-day percentage decline in silver's entire recorded history. If you blink in the financial markets, you can miss a lot, but this was impossible to miss. The shockwaves are still reverberating through precious metals markets right now, and if you're holding silver, thinking about buying silver, or just trying to understand what on earth just happened, you need to hear this story. Let's set the scene. Just one day before this historic crash, on January 29th, silver had reached an all-time high of $121 per ounce. Think about that for a moment. Silver, which many investors had been accumulating at $20, $25, maybe $30 per ounce over the past few years, had exploded to $121. The rally seemed unstoppable. Analysts were calling it the beginning of a new supercycle. Social media was flooded with posts about silver to the moon. Physical dealers couldn't keep products in stock. The euphoria was palpable. And then, in less than 24 hours, it all came crashing down. By the time markets closed on January 30th, silver had plummeted to around $78 per ounce. Over the next 3 days, the carnage continued, with silver ultimately falling 41% from its peak, bottoming out around $60. Billions of dollars in paper wealth evaporated. Leveraged traders got completely wiped out. Margin calls forced liquidations across the board. It was, by any measure, one of the most dramatic price collapses in commodity market history. So what actually happened? How does a market that seemed so strong fall apart so quickly? The truth is, this wasn't caused by just one factor. This was a perfect storm, a confluence of events that aligned at precisely the wrong moment for silver bulls. But there were two main catalysts that lit the fuse, and understanding them is crucial to understanding not just what happened, but what might happen next. The first catalyst came from the highest levels of American political power. President Donald Trump announced his nomination of Kevin Warsh as the new Federal Reserve Chair. Now, if you're not deeply embedded in financial markets, you might be wondering why a Fed chair nomination would matter for silver prices. Here's why it matters enormously. Kevin Warsh has a well-established reputation as a monetary hawk. He's known for favoring tighter monetary policy, higher interest rates, and a strong dollar. This stands in stark contrast to the loose monetary conditions and weaker dollar environment that had been fueling the precious metals rally. Silver, like gold, typically performs well when the dollar is weak and when investors are concerned about inflation or monetary debasement. The Warsh nomination signaled a fundamental shift in monetary policy direction. Markets immediately began pricing in expectations of higher real interest rates and a stronger dollar, both of which are kryptonite for precious metals. The dollar index started strengthening and yields began adjusting higher. For silver, which had been pricing in a very different monetary future, this was a game changer. But here's where it gets really interesting and where the second catalyst comes into play. The silver market wasn't just riding on fundamental demand or long-term investment positioning. It was absolutely loaded with leverage. Speculative traders had piled into silver futures contracts, many of them using significant margin to amplify their potential gains. When prices are going up, leverage is your best friend. It multiplies your profits. But when prices reverse, leverage becomes a death trap. The Chicago Mercantile Exchange, which operates the primary silver futures market, saw what was happening. They saw the extreme positioning, the massive buildup in speculative interest, and the potential for systemic risk. So they did what exchanges do when things get too frothy. They raised margin requirements. The CME increased margin requirements from 11% to 15%. That might not sound like much, but in the world of leveraged futures trading, that's enormous. Here's what that means in practical terms. If you were a trader holding $1 million worth of silver futures contracts at 11% margin, you needed to have $110,000 in your account. This created what traders call a cascading liquidation event. As prices started falling on the Warsh news, margin calls went out. Traders who couldn't meet those margin calls had their positions automatically sold by their brokers. Those sales pushed prices lower. Lower prices triggered more margin calls. More margin calls meant more forced selling. It's a vicious cycle that feeds on itself, and it doesn't stop until all the weak hands are shaken out of the market. The sheer speed and magnitude of the decline tells you just how leveraged the market had become. In a healthy market with mostly physical holders and long-term investors, prices don't fall 35% in a day. They can't, because those holders aren't forced to sell. They might not like seeing their positions down, but they can hold through volatility. Leveraged futures traders don't have that luxury. When margin calls come, they have no choice. They must sell, regardless of price. What made this particularly brutal was the lack of buyers. When a market is in free fall, especially one driven by forced liquidation, buyers disappear. Who wants to catch a falling knife? Market makers widened their spreads. Liquidity evaporated. This meant that even relatively small sell orders were moving prices dramatically because there simply weren't enough bids to absorb the selling pressure. It became a self-reinforcing panic. Now, where does silver stand today, and what comes next? As of this morning, February 9th, silver has staged a significant recovery. The metal is currently trading around $81 per ounce, up approximately 5% today alone. During today's session, silver actually touched $83, representing a gain of over 6% from Friday's close. That's a substantial move, and it tells us that despite the trauma of late January, there's still significant buying interest in silver. The recovery we're seeing isn't happening in a vacuum. Several factors are supporting this bounce. First, U.S. inflation expectations have been easing, with 1 year ahead expectations falling to 3.1%. That might seem counterintuitive. Shouldn't lower inflation expectations hurt silver? But what matters more for precious metals right now is real yields, and those have been softening. The dollar has also weakened ahead of key upcoming economic data releases, including jobs numbers and CPI figures. A weaker dollar provides tailwinds for dollar-denominated commodities like silver. There has also been an interesting development out of Japan. Prime Minister Sanae Takaichi recently secured an election victory, and her administration is expected to pursue expansionary fiscal policy. This has implications for global liquidity and currency markets, potentially creating an environment more supportive of precious metals. Add to this the fact that silver had become dramatically oversold from a technical perspective after the crash, and you had all the ingredients for a sharp bounce. But here's the critical question. Is this a dead cat bounce, or the beginning of a genuine recovery? The honest answer is that we're in a period of extreme uncertainty. Major investment banks are weighing in with their forecasts. UBS, for instance, has put out an interesting call. They're forecasting that silver will climb back to $100 per ounce by next month. That's March 2026. However, they then expect it to fall back to $85 by year end. Their reasoning is important to understand. They note that over 50% of silver demand is linked to industrial applications, particularly in solar panels, electronics, and green energy technologies. At prices above $80, let alone $100, industrial buyers start looking for substitutes or ways to reduce silver content in their products. Demand destruction becomes a real risk. There's another crucial factor that investors need to watch closely: the Chinese Lunar New Year. This runs from February 16th through February 23rd, just 1 week away. During this period, Chinese markets essentially shut down, and Chinese participants, who represent enormous liquidity in precious metals markets, step away. This could create thin trading conditions with unpredictable price swings. After what we just witnessed in late January, the prospect of reduced liquidity should make any silver investor nervous. The physical silver market is telling a different story than the paper market. Despite the price volatility, demand for actual physical silver products remains robust. Premiums on 2026 bullion coins and bars are elevated. Dealers report strong buying interest from investors who see these price levels as opportunities. There are also ongoing concerns about supply constraints in the London market, which is a critical hub for physical silver trading. When the paper market and physical market start diverging like this, it often signals that something important is happening beneath the surface. Looking at the bigger picture, despite all the recent chaos, silver is still up 160% compared to where it was 1 year ago. Yes, it's down about 2% over the past month, but that monthly decline includes one of the most violent sell-offs in commodity history. The fact that silver has recovered as much as it has, as quickly as it has, suggests that the underlying bull market thesis hasn't been completely destroyed. So what should investors take away from all this? First, understand that the silver market has fundamentally changed. The volatility we saw isn't going away. This is now a market characterized by extreme swings, heavy speculation, and the constant risk of leverage-induced crashes. If you can't stomach seeing your positions swing 30% or more in a matter of days, silver might not be the right investment for you right now. Second, the distinction between physical silver and paper silver has never been more important. Physical holders who weren't leveraged weathered the storm. They saw their net worth decline on paper, certainly, but they weren't forced to sell at the worst possible moment. Leveraged futures traders were destroyed. If you believe in silver's long-term prospects, physical ownership eliminates the risk of forced liquidation. Third, pay attention to the macro drivers: Fed policy, dollar strength, real yields, inflation expectations. These aren't just abstract economic indicators. They're the fundamental forces that drive precious metals prices. The Warsh nomination mattered because it signaled a policy shift. Future policy announcements will matter just as much. The silver market just taught us an expensive lesson about euphoria, leverage, and the speed at which sentiment can reverse. Whether you're a long-term stacker, an active trader, or just someone trying to preserve wealth, the events of late January will echo through this market for months to come. The question now is whether silver can rebuild trust, find stable footing, and resume its longer-term uptrend, or whether this is the beginning of a more prolonged correction. Only time will tell, but one thing is certain. Anyone involved in this market needs to be prepared for continued turbulence ahead.